The trade that destroys your day is almost never the first one. Think about your last bad trading session. You probably started well. Maybe you had a clean entry. Maybe it worked. Maybe you were up. And then something shifted. Not in the market. In you. You kept going. You took another setup. Then another. Then one that didn't quite qualify. Then one that definitely didn't. And by the end of the session, the profit was gone. Sometimes worse than gone. The market didn't take your money. Your behavior did. And the painful part is this. You already had your best trade of the day early on. Everything after that was noise you chose to participate in. This video is about that exact problem. Not how to find more trades. How to stop taking the wrong ones. Most traders do not overtrade because they are reckless. They overtrade because the market is always moving, and movement feels like opportunity. When price is active, when candles are forming, when momentum is building, your brain reads that as signal. It reads it as possibility. And so you engage. Even when there is no real setup. Even when the conditions are not right. Even when, if you were honest with yourself, you would admit the trade does not meet your own standards. This is the hidden problem with overtrading. It does not announce itself. It disguises itself as participation. Let's walk through how a typical session deteriorates. You sit down before the London Open. You have done your analysis. You know the key levels. You know where the liquidity sits. You are focused. The first setup forms cleanly. A sweep of the Asian session low. Price reacts quickly. Structure holds. You enter with precision. The trade moves in your direction. You manage it well. You close it at your target. You are up. The session has been profitable. And then the boredom starts. Price consolidates. Nothing is setting up. The market is choppy, directionless, grinding sideways. But you are still watching. You are still waiting for something to happen. And because you are watching, your brain starts finding patterns that are not really there. You start to bend your rules. The structure is not quite right, but the momentum looks promising. The confirmation is missing, but the candle looks strong. The level is not exact, but it is close enough. You take the trade. It does not work. Now you are slightly down from where you were. And this is where it gets dangerous. Because now there is a new emotion in the room. Recovery mode. Revenge energy. The need to get back to where you were. You take another trade. Slightly impulsive. Maybe it works. Maybe it does not. Either way, you are no longer operating at the same decision quality as your first trade. Not even close. This is how sessions unravel. Not in one dramatic moment. Slowly, quietly, trade by trade. Mental fatigue plays a significant role in this. The human brain is not designed for sustained, high-focus decision-making over several hours. After 1 hour of watching price, your cognitive sharpness decreases. After 2 hours, your ability to distinguish between genuine setups and noise degrades noticeably. After 3 hours, many traders are operating almost entirely on emotion while believing they're using logic. The market does not care about your fatigue. It keeps moving, and a tired, frustrated trader keeps engaging. FOMO makes this worse. You miss a move. Price ran cleanly from a level you identified but hesitated on. And now you feel like you have already fallen behind. So you start chasing. You enter late into a move that is already extended. You buy near the top of a rally because you do not want to miss it again. And the market, as if it can sense the desperation, reverses almost immediately. None of this is random. Emotional traders create predictable behavior patterns. And those patterns get exploited. Let's talk about something traders often ignore. The cumulative cost of low-quality trades. Every trade you take has a spread. Most trades carry some slippage. If you are in a market with commissions, every entry and exit has a real monetary cost. This is fine when your edge justifies participation. When it does not, you are paying to lose. But the financial cost is actually the smaller problem. The larger cost is what repeated, low-quality trading does to your decision-making. Every time you enter a trade, your emotional state shifts. A trade in profit creates confidence. A trade in loss creates defensiveness. A break-even trade creates mild frustration. Each of these emotional states colors the next decision you make. Stack 10 or 15 of these in a single session, and your objectivity has collapsed entirely. You are no longer reading the market. You are reacting to your own emotional history from the past few hours. This is why professional traders are extremely protective of their mental state. They know that clarity is a resource. Once it is spent, it cannot simply be refilled during the same session. There is also the issue of diminishing execution quality. Your first trade of the day, when you are fresh and your plan is clear, is almost always your best trade. Your entries are tighter. Your reasoning is sharper. Your risk management is cleaner. As the session progresses and your brain accumulates stress, exposure, and stimulation, these qualities degrade. Many traders have noticed this pattern without fully understanding it. They journal their trades and discover that their first 1 or 2 setups per day outperform everything that follows. This is not coincidence. It is the direct effect of cognitive depletion on execution quality. Constant market participation also removes objectivity. When you are always in a trade or always looking for one, you cannot see the market neutrally. You start seeing what you want to see. You start interpreting price action in ways that confirm what you are already positioned for. You rationalize. You ignore the signals that contradict your bias. And when the market eventually proves you wrong, you are often surprised, even though the evidence was visible the whole time. Professionals protect objectivity by spending time away from the screen. They step back deliberately. They take breaks after trades, both winning and losing. They allow their emotional baseline to reset before they engage again. This is not laziness. It is tactical behavior. Here is the core principle this video is built around. One good trade is enough. This is not a motivational slogan. It is a strategic reality that the best traders in the world operate by. Professional traders, the ones managing real capital, the ones with verifiable track records, the ones who have survived multiple years in live markets. They do not measure their performance by how many trades they take. They measure it by the quality of the opportunities they select and the precision with which they execute. Some of the most consistently profitable traders in the world take fewer than 5 trades per week. Some take fewer than that, not because the market lacks movement, not because there are no setups, but because they have learned something that takes most traders years to understand. The market gives you a small number of genuinely high-quality opportunities each week, a much larger number of mediocre setups, and an enormous number of noise events that look like setups but are not. Amateurs try to trade all 3 categories. Professionals trade only the first. This is the fundamental difference in mindset. The amateur asks, how many trades can I take today? The professional asks, is this trade truly worth taking? Think about what that shift actually means in practice. It means you are no longer reactive. You are selective. You are no longer chasing every candle. You are waiting for the candle that matters. You are no longer trying to manufacture opportunity. You are recognizing when it genuinely appears. Elite traders often describe long periods of doing absolutely nothing. Hours of watching, waiting, observing the market with no intention to enter. Not because they lack confidence, because they understand that patience is a position. Not trading when conditions are poor is itself a trading decision, and often a correct one. Amateur traders find this unbearable. The stillness feels like failure. It feels like missed opportunity. It produces anxiety, boredom, and eventually impulsive behavior. The amateur needs constant stimulation from the market because they have not learned to separate stimulation from opportunity. The professional has made peace with inactivity. They understand that the market will be open tomorrow, that there will be another session, that missing a setup is far less damaging than forcing a bad one, and that the psychological cost of a forced, losing trade extends far beyond the monetary loss. Capital preservation is part of profitability. This is another concept that takes time to fully internalize. Every dollar you lose on a low-quality trade is a dollar that was not available for a high-quality one. Every session you end flat or negative due to overtrading is a session where your best trade of the day was erased by everything that followed. One clean trade that captures 50 pips, or 2%, or whatever your target is, that is enough. Bank it. Step back. Come back tomorrow with the same clarity you had when you started. The phrase, wait for A-plus setups, is common in trading education. It is also almost useless unless you define what a plus actually means. So let's do that. A high-quality setup is not defined by how strong a candle looks or how much momentum there appears to be. It is defined by the alignment of multiple factors that together create a genuinely favorable risk-to-reward situation. The first factor is market structure. Price moves in a directional framework. It creates higher highs and higher lows in an uptrend, lower highs and lower lows in a downtrend. When you trade with structure rather than against it, You are trading with the dominant flow of institutional money. When you trade against it, you need the market to reverse, and reversals require much more evidence than continuations. The second factor is liquidity positioning. Before price makes its real move, it frequently sweeps a liquidity pool first. Retail stop losses accumulate below obvious lows and above obvious highs. Algorithms push price into those areas, trigger the stops, collect the liquidity, and then move in the intended direction. If you understand this behavior, you can position yourself after the sweep rather than being the one getting swept. A high-quality setup often looks like this. Price sweeps a key low in a bullish environment, wicks sharply below the level, and then closes back above it with conviction. That failed breakdown is not random. It is the market clearing the sell-side liquidity before pushing higher. Entering after that sweep, with a tight stop below the wick and a clear target at the next structural level, gives you a strong risk-to-reward framework. The third factor is clear invalidation. Before you enter any trade, you must know exactly where the trade is wrong. Not approximately wrong. Exactly. Your stop placement must be logical, not arbitrary. If price reaches your invalidation level, the premise of the trade is no longer valid. You exit. No hesitation, no hoping. Trades without clear invalidation are not trades. They are gambles. The fourth factor is timing. The same setup can behave completely differently depending on when it appears. During the London Open, when institutional volume is highest, a break and retest of a key level will typically follow through cleanly. During the dead zone between the London Close and New York Open, the same setup might chop and stall. Algorithmic behavior changes across sessions. Liquidity conditions shift. A setup that appears during a high-volume window is worth more than the identical setup during low liquidity. Trade during the hours when your setup type performs best. Ignore the market during the hours when it does not. The fifth factor is confirmation. Do not anticipate. Wait for the market to show you what it intends to do, and then react. Confirmation can take many forms: a specific candle closing pattern, a momentum shift on a lower time frame, a break of a minor structural level in the direction of your trade. What matters is that you are responding to price behavior, not predicting it. The sixth factor is volatility. Low volatility environments produce choppy, unpredictable price action. Your stops get hit. Your targets do not get reached. High volatility periods, driven by session overlaps, significant news events, or algorithmic triggers, produce clean, directional movement that allows your setups to work as intended. When volatility is low, the correct response is often not to adjust your entries. It is to wait until conditions improve. The seventh and final factor is risk-to-reward logic. Before every trade, calculate whether the potential reward justifies the risk you are taking. A minimum of 2-to-1 is a reasonable baseline. 3-to-1 is better. Some traders only take setups with 4 or 5-to-1 potential. The higher your required risk-to-reward ratio, the more selective your entries will naturally become, and the fewer, higher quality trades you will take. When all 7 of these factors align, structure, liquidity positioning, clear invalidation, timing, confirmation, volatility, and risk to reward, you have something worth executing. When 2 or 3 are missing, you do not have a setup. You have a story you are telling yourself to justify entering. Understanding the concept of selective trading is one thing. Actually implementing it requires structure. Without a concrete framework, good intentions collapse under the pressure of live market conditions. Here is a practical session discipline system. Before each session, define your maximum trade count. For most retail traders, 1 to 3 trades per session is more than sufficient. Write it down. Commit to it before the market opens. When you reach that number, you are done, regardless of what the market does afterward. This sounds simple. It is not easy. The market will do something interesting after your third trade. Something that looks like a perfect setup. Something that makes you want to break your rule just this once. Do not. The rule exists precisely for that moment. Next, conduct pre-session planning before you open any charts. Identify the key levels where setups could form. Mark the zones where liquidity is likely sitting. Note the market structure direction on the higher time frame. Decide what conditions must be present for you to take a trade. Write this down. When the session begins, your only job is to observe whether those conditions appear, not to search for new reasons to enter. Third, define what done for the day looks like for you. This should include both a profit target condition and a loss limit condition. If you reach your daily profit target, you are done. Not because the market has stopped moving, because your goal for the day has been achieved. Trying to push further when you are already at your target is how profitable days become break-even days. If you reach your daily loss limit, you are also done. Immediately. No exceptions. The loss limit exists to prevent you from compounding a bad session into a catastrophic one. Every trader has bad sessions. Professional traders have bad sessions that are contained. Amateur traders have bad sessions that destroy weeks of progress. Fourth, practice post-win discipline specifically. This is the area most trading education ignores. After a winning trade, particularly a significant one, do not immediately look for the next entry. Take a minimum 15-minute break. Step away from the screen. Let your emotional state return to neutral. A winning trade generates excitement, confidence, and sometimes overconfidence. Trading from that elevated emotional state is dangerous. You are more likely to see setups that are not there, more likely to size up inappropriately, more likely to hold on to losing trades because your confidence feels justified. The break is not optional. It is structural. Fifth, recognize when market quality has deteriorated. Not every session offers tradable conditions. Some sessions are choppy, low volume, directionless. Price oscillates between levels without committing to a direction. Spreads widen. Slippage increases. These are not conditions where your edge functions properly. The correct response is not to adjust your approach and keep trading. It is to close your platform and wait for a better session. Professional traders are comfortable saying, the market was not tradable today. Amateur traders feel that every active session is a session where they should be participating. Sixth, trade only during high liquidity windows. For most markets, this means the London Open, the first 2 hours of the New York session, and the London-New York overlap. These are the periods where institutional activity is highest, where price moves with the most directional clarity, and where your setups are most likely to follow through. Avoid trading during the Asian session unless your strategy is specifically designed for it. Avoid trading in the final hour before major news events unless you are fully aware of the risk. And avoid trading during the dead zones when volume has evaporated and algorithms are simply searching for liquidity without clear direction. Let's go through the most common execution mistakes that destroy session discipline, not as a list of rules to memorize, but as an explanation of why they happen, because understanding the cause is what actually allows you to correct them. The first mistake is trading immediately after a win. You just closed a clean trade. Everything worked. Your analysis was correct. Your execution was precise. And now, while the dopamine is still running, you start scanning for the next entry. The problem is that a winning trade does not improve the quality of your next setup. The market does not reward momentum. Your emotional state, however, has shifted, and it is now compromised. Trading immediately after a significant win almost always results in a lower quality entry than your first trade. Take the break. The second mistake is revenge trading after a loss. This is perhaps the most well-documented mistake in trading psychology, and also the most difficult to control in live conditions. You had a clean setup. It hit your stop. The loss is real. The frustration is real. And now there is a powerful, almost physical urge to immediately find another trade and recover what you just lost. This urge is not based on market analysis. It is based on emotional pain. The trades that come from this state are almost always impulsive, undersized in terms of preparation, and oversized in terms of risk. They frequently make the situation worse. Step away after a losing trade. Let the frustration dissipate before you look at the charts again. The third mistake is forcing trades during low volatility. The market is quiet. Nothing is happening. But you are at your screen, ready to trade, and your brain needs stimulation. So you start looking harder. You zoom into smaller time frames where noise looks like signal. You identify patterns that do not exist on the time frames that matter. You enter a trade during conditions where your setup type does not function properly. The market chops. Your stop gets hit. You had no edge. You just had boredom. The fourth mistake is entering late due to FOMO. You saw the setup. It formed cleanly. You hesitated. Price moved in your expected direction without you. And now the trade is running, your expected target is approaching, and you are watching from the sidelines. So you enter anyway. Late. At a poor price. With a reduced risk to reward ratio. often near the point where the move is about to exhaust. This is not participation. This is chasing. The next setup will come. Let this one go. The fifth mistake is mistaking movement for opportunity. A large candle forms. Price is moving fast. It feels like something is happening. You enter, not because a setup has formed, but because you feel urgency. You confuse volatility with directional clarity. And often, that large candle was not the beginning of a move. It was the end of one. Volatility alone is not an entry signal. The sixth mistake is lowering your standards after missing a setup. You identified the perfect entry zone. Price approached. You waited for confirmation. And then price moved without giving you the confirmation you required. It worked without you. And now the next setup that forms, you take it without confirmation because you do not want to miss again. This is your standards being eroded by frustration. The confirmation requirement exists for a reason. Missing one setup is not a reason to remove your filter. Patience is a competitive advantage. This is not a philosophical statement. It is a structural reality of modern markets. The majority of retail traders are impatient. They enter too early. They exit too early. They take too many trades. This behavior is predictable, and modern market-making algorithms are built to exploit it. Stop hunts exist because retail traders cluster their stops at obvious levels. Fake breakouts exist because retail traders chase momentum. Liquidity sweeps exist because retail money is positioned exactly where it should not be. When you practice patience, when you wait for the sweep, wait for the confirmation, wait for the spread to tighten, wait for the volatility to expand in your direction, you are effectively stepping out of the pool of predictable retail behavior. You are no longer the person being exploited. You are the person waiting for the exploitation to complete before you enter. Less screen time can genuinely improve execution. This sounds counterintuitive. Surely more observation means better analysis. In practice, extended screen time increases emotional engagement with price, reduces objectivity, generates boredom-driven entries, and accumulates mental fatigue. Many traders who deliberately limit their screen time to 2 hours per session find that their execution quality improves. They miss fewer setups than they expect. They take fewer bad trades, and their performance metrics improve. Try it as an experiment. Set a timer for 90 minutes from the open. When the timer ends, close your platform, regardless of whether you traded or not. See what happens to your week's performance. Modern markets are largely algorithm-driven. Price does not move randomly. It moves according to liquidity. Algorithms seek out pools of resting orders, the stops clustered below key lows, the pending orders sitting above resistance, and they push price into those areas to fill institutional orders before distributing in the other direction. This behavior is consistent and identifiable if you know what you are looking for. The trap is not random. The stop hunt is not random. The false breakout is not random. These are the market's mechanism for transferring money from impatient, reactive traders to patient, structural ones. Understanding this changes how you read price action. You stop being surprised by stop hunts. You start expecting them, and you start positioning yourself to benefit from them rather than be victimized by them. Preserving emotional neutrality improves pattern recognition. This is one of the most underappreciated insights in trading. When you are emotionally engaged, excited, anxious, frustrated, hopeful, your perception of price action changes. You see what you want to see. Patterns that confirm your bias appear more frequently. Evidence that contradicts your position gets filtered out. Traders who maintain emotional neutrality throughout the session, neither too excited by wins nor too affected by losses, consistently make better read decisions. They recognize patterns more accurately. They identify when their thesis has been invalidated and exit cleanly rather than holding in hope. They do not need the trade to work. They simply execute the plan and accept the outcome. This is not an emotional state you can manufacture on demand. It is built by practice, by structure, and most importantly, by not overexposing yourself to market noise. The fewer unnecessary trades you take, the more emotional energy you preserve, and the cleaner your perception remains. Let's bring this back to the core idea. You do not need more trades. You need better ones. The market is not going anywhere. It will be open tomorrow, next week, next month. There will always be another session, another opportunity, another moment when the conditions align and a genuinely clean setup forms. What is finite is your decision quality per session, your emotional energy per session, your ability to read the market clearly. These resources deplete, and every unnecessary trade you take accelerates that depletion. The traders who make money consistently over years are not the ones with the highest trade frequency. They are the ones who have developed the discipline to take very few trades, executed very well, in conditions that genuinely favor their approach. That is a skill, and like every skill in trading, it is built through deliberate practice, honest self-assessment, and a willingness to sit on your hands when the conditions are not right. Here is a practical challenge. In your next 5 sessions, set a maximum of 2 trades per session. Before each entry, ask yourself, if I could only take 1 trade today, would this be the one I choose? If the answer is no, do not take it. Wait. See what happens. You may miss some moves. That is fine. What you will not do is erase a profitable session by overtrading. What you will not do is end the day frustrated, depleted, and confused about what went wrong. One good trade builds your confidence. One good trade protects your account. One good trade teaches you more about your own execution than 20 impulsive ones ever will. The market rewards restraint. It rewards timing. It rewards precision. Not activity. Not effort. Not screen time. One clean, well-executed trade, taken at the right moment, in the right conditions, with the right risk management, can outperform an entire day of emotional market participation. Remember that the next time the urge to overtrade arrives, and it will arrive. It always does. The question is whether you will act on it, or whether you will wait.